And we're live. Welcome everybody to Wealthion's first live cast. And what we're going to do today is we're going to do Ask Anything Money Q&A with Wealthion's endorsed financial advisors. And I have them all here with us. I have the lead partners from New Harbor Financial, John Lodra and Mike Preston. Hi guys, how you doing?
Hey Adam, good to be here. Thanks.
Hi Adam, how are you? Glad to be here. And hello, Lance.
This is going to be fun. Yes. And we also have Lance Roberts from Real Investment Advisors. Lance, how you doing?
I'm good. Hi, everybody. Glad to be here.
All right. Well, I appreciate you guys getting together for this. And guys, just have had a ton of interest from our audience around this. We have done this before in years past in conferences that we've done, but we've never actually done it live in front of the general public. And folks watching, if you enjoy this, we will try to make this a regular occurrence. So let's see how this first inaugural one goes, and then we'll go forward from there. All right, so here's what the ground rules are going to be, folks. To ask your questions, ask them in the live chat here, and I'll be monitoring that and pulling out questions for our experts here. If you want to ask your question live on air, meaning coming in and being here on camera with us, send your question to info@wealthion.com, and I'll do my best to monitor that during this experience. And what will happen is if I select your question, I will email you a link. If you click on that, it'll pull you into the green room here, and then I'll bring you in when we have time to ask your question directly to our speakers here. All right, guys. Well, look, I got a bunch of questions submitted in advance from folks. So why don't we start with one or two of those, and I'll start bringing in some from the live stream. There's been a lot of talk on this program in recent past about the likelihood of a recession approaching. We've talked a fair amount about the inverted yield curves. Bradley asks, should I keep investing through the coming recession or stay more in cash? Let's see here. I'm just going to direct this to you guys and let you kind of ping pong around this. How about John Lodra? I'll let you start with that, and then Lance, I'll let you chime in because I know you and I have talked a lot about the
Sure.
Inverting yield curve and whether or not a recession's coming ahead. But John, should somebody be sort of adding in as we go into recession, so they use that as a dollar cost averaging opportunity, or should they just hunker down in cash and just ride it out until the storm's over?
Yeah, that's a good question. The way I'd like to start by answering that, there's many ways to skin a cat, right? And there's many strategies, many approaches. And, far be it from us to say our approach, our strategy is the only way. The really important thing in any kind of investment strategy is having realistic expectations about its likely path, given the environment we're in now and where we'll be over time. Sticking to that strategy, frankly, because one of the worst sins an investor can make is to change strategies when it doesn't seem to be working. That is the often studied Dalbar study or whatever. There's some studies out there. The point being is that human psychology wants to do what feels right in the rearview mirror, but oftentimes will prove wrong in the forward looking. So if you're holding cash, I would firstly ask why you're holding cash. We happen to think holding cash right here and now is a great thing to be doing because of how extreme valuations are. There's nothing about that says they can't become more extreme. But if you look at over a century of data, there are periods of time when valuations get very rich, not even close to as rich as they are right now, where over long stretches of periods, cash will outperform even stocks, or at least historically, with a high degree of probability. Take, for example, the housing bust in 08-09. When the market bottomed in March of 2009, any benefit of being in stocks all the way back to 1996, I think, was wiped out. You would have been just as well being in T-bills over that 14 or so year period. Now, by no means should one take that to mean that you should have actually been in cash the whole period of time. But what it speaks to is when markets get crazily overvalued, like they did in the tech bubble and the housing crescendo, any benefit of being in stocks likely is oftentimes wiped out with devastating consequences. So, of course, the strategy there, in our opinion, is to have been lightened up in those major peaks in the stock market, which, by the way, right now we're at valuations that far eclipse both of those crescendos. So the simple answer is we think cash is a good place to be right now. And any pivoting off of cash, I think, should be in degrees relative to the moderation of the extremities we see now. Simply put, the more valuations get moderated to more reasonable levels, the more invested one should be. And one can be fully invested but still have hedges and things like that. So there's a very complicated answer to that question, but I don't think it starts with understanding why you're in a certain position, what your strategy is, and will you stick to that strategy over the first full market cycle.
You're on mute, Adam.
Yeah.
Yep. All right. First time we're doing this, folks. There's going to be a couple of hiccups like that.
Whatever you were saying was very entertaining, though. That was good.
All right. Well, Lance, I'll let you build on anything you want to add to what John said, but I'm just noting we're already getting a ton of questions here in the live chat. So this is going to be a pretty busy hour, guys.
No problem. Real quick, not a lot to add to what John said. Just remember that in a recession. So first of all, by the time you get the inversion of the yield curve to the time you actually get the onset of a recession, will be longer than you expect. The other problem is that by the time the National Bureau of Economic Research announces the recession, then you'll have to look back in time and say, oh yeah, the recession was 9 months ago, and that's when it actually started. What will tell you that you're going into recession is when the yield curve uninverts. And that'll be the point to where the recession backdating will occur to, but that's what will tell you that you are actually in a recession. Now, to John's point, he's absolutely right. Trying to dollar cost average through a recession, if you're trying to passively buy indexes and things, aren't going to work out well for you, because you're going to destroy capital all the way down that recessionary drag, whatever it is, 20%, 30%, et cetera. Average recessionary drawdowns are about 33% on average. However, saying that, there will be opportunities to own things in a recession. Just because the indexes are in a recession doesn't mean that everything's in a recession, doesn't mean everything's going down. Bonds will do exceptionally well during a recessionary spat. They'll have large capital appreciation. So I can invest money in bonds and protect capital and make money during a recession just by buying bonds. But there'll be sectors of the stock market that also do better than the broad averages. So again, to John's point, it's really, you have to really determine what it is that you're trying to achieve through your investment allocation, but more importantly, how you're allocating those assets with respect to the amount of risk you're taking in your overall portfolio. And look, like John, right now we're carrying a good bit of cash because we're worried, just like John is, that with valuations where they are, with the Fed hiking interest rates, there's a lot of things that suggest markets could be in a little bit more trouble here over the course of this year, until the Fed starts lowering rates back to zero and dumping another couple of trillion into the market every month. That'll be a different conversation when we get there.
All right, great. Okay, next question is about bonds. And guys, I think what I'm going to do is I'm just going to, throw these questions out and just raise your hand, and I'll call on whoever most wants to answer. But I'm looking through the question here, but I can't find it again. But it basically was saying, hey, do you think that, potentially looking at some of these macro risks, that bonds are going to be a good investment going forward? Mike, why don't we start with you? Because I know you guys just recently, I think, bought some bonds or said that you were looking at buying some bonds. And Lance, I'm going to guess that, you and I have talked about bonds a lot recently on the weekly market recaps. You're probably going to chime in too. But right. Mike, why don't you go ahead real quick before you do? Somebody just asked here, hey, how do I ask a direct question? If you didn't hear me earlier, send an email to info@wealthion.com, and I can send you the link and we'll pull you in here and you can ask your question live on camera if you want to. All right, Mike, back to you about bonds. What's the outlook for bonds here?
Yeah, we think that bonds actually offer a short-term opportunity. You've got to be careful because interest rates have been at 40-plus year lows for a long time, over 10 years. In response to the great financial crisis of 2008, 2009, central banks have essentially engaged in a war on cash. And the way to do that is to buy bonds like crazy and drive interest rates down to zero, which is what happened. That, of course, created a huge bull market in bonds in really a bull market in bonds that's been going on through 30 plus years. And early this year, there was a big sea change in all of a sudden, the public and the market became aware that the Fed was almost certainly going to tighten. And we saw one of the fastest increases in rates that we've seen in modern times. Mortgage rates, which are directly tied to 10-year U.S. Treasury bonds, have had a rapid increase. Doesn't seem to be affecting the real estate market yet, but it probably will. And we'd be careful about being too speculative in real estate because of it. Mortgage rates went from about 2.75 or 2.75% on a 30-year mortgage to over 4% in a span of just a few months. And all of that is to say that the price of bonds has gone down significantly in the first quarter. And if you look at junk bonds or high yield bonds, we were running at about 18 trillion or so in negative yielding bonds worldwide for years on end. And I was just looking at a chart recently, we're down to about $3 trillion in negative yielding debt. And what that means essentially is that the price of these bonds have come down some, which have pushed the yields up because it's an inverse relationship. All of that is to say that bonds are a little bit more attractive now than they were a few months ago. In the big picture, though, rates are still quite low and could go higher. And if they go higher, there's some additional risk to bonds. Having said that, though, we've been looking at bond interest rates for a potential entry, particularly on a shorter term time frame. On the 10-year U.S. Treasury bond, we were looking for somewhere between 2.3 and 2.5% as a short-term target, where we thought it would stall. It actually reached there in the last couple of weeks. Because of that, we put on a trade, and we call it a trade because it's a shorter-term position in long-term U.S. Treasury bonds. We used an ETF that holds 20-plus year U.S. Treasury bonds, and we bought that with the objective of maybe holding it a few months. We wrote a call option against it, too, to increase income and to hedge a little bit. So we like bonds here over the intermediate term. It's even possible eventually that after some kind of market crash that the Fed will go crazy with money printing, and then maybe they'll drive rates all the way back down to zero. If that happens, then bonds could be a really good intermediate to longer term play. Right now, we like it over the short term. We'll probably be out of the trade in a few months. Longer term, after some kind of stock market crash, if the Fed gets very involved in easing again, we'll probably like it for a longer term time frame.
Adam, you're on mute again.
I was just saying, I'm kind of beginning to learn this new environment we're in. And of course, I was stuck on mute there. We're using a different software to run this live event, folks. And it's kind of got these cool bells and whistles. So you can see here that I can actually pull up people's questions here as they're getting answered. Lance, you don't have to, but I assume you might want to build a little bit on what Mike said there. And Adrian here sort of asks about bonds. Hey, if you think they're a good buying opportunity, what kind of return are you expecting, for the bonds you're purchasing right now? Is this you're trying to hit a single, a double, or is this something you're swinging for the fences for?
Well, I'll let, we'll talk about returns here in a second, because it depends on whether it's a short-term trade or a longer-term trade. But the issue is absolutely right. First of all, the Fed is, tightening monetary policy. They are about to get into quantitative tightening. And when that occurs, rates rise in anticipation of that. And that's exactly what's occurred. Now, if you go back to 2018 as an example, the Fed was hiking interest rates and they were starting their quantitative tightening. And at that point, Jeff Gundlach had come out and said, rates are going to 6%. And we wrote an article rebutting that, saying, no, rates are going to go below 1% or potentially even to zero. And over the next 2 years, we got down to 0.5% on terms of interest rates. And the reason for that is, again, when the Fed begins tightening, we just talked about this, the inversion of the yield curve, recession, those type of things. Well, when the Fed's extracting monetary liquidity from the markets, investors only have two choices. They can do risk on or risk off. Risk on is equities, risk off is bonds. So once the quantitative tightening ensues, people will start making a risk-off decision in markets. Equities are going to come down, just like we just talked about. Well, if equities are coming down, the money flows have to go somewhere. So as money flows rotate into bonds for safety, and they tend to rotate into long-term treasuries to do that. So most likely in the next 6 to 9 to 12 months, depending on how long it takes to get there. And again, the important thing to understand is that we're talking about the Fed acting in a vacuum here. We're talking about the Federal Reserve hiking rates and tightening their balance sheet in a vacuum. The problem is that high inflation, high oil prices, what's happening economically, the extraction of liquidity that was all put into the markets back in 2020, 2021, that $5 trillion of liquidity is now all coming out of the market. That's all gone, right? All the extended unemployment benefits, that's all extracted. Now, importantly, that's monetary tightening. That's already tightening monetary policy. Now the Fed's going to tighten that policy even more, which is going to potentially accelerate that time to a recession. So when that occurs, rates are going to head back to 0.5%, potentially even 0, and you're probably talking somewhere between a 20 to 25% gain on 20-year bonds from where they're currently trading conservatively.
All right, great. So one more question about bonds here, and I'll let anybody jump in on this. Charger Mopar says, I want to know if the Fed will ever lose control of interest rates. Why are bond rates allowed to be below inflation? Is there any limit to this stupidity?
I guess I'll
John,
take a shot at that to have a little word on bonds. So I love the handle, by the way. It must be a car person there, Charger Mopar. I can visualize a nice vintage car there. Will the Fed ever lose control of interest rates, and why are they allowed to go below inflation? So let's talk about the second part there. What we have seen over the last decade is a unprecedented experiment in monetary policy to try to so-called stimulate demand in the wake of the housing bubble, and purposefully. Central banks across the world, led by our Federal Reserve, drove interest rates down through various mechanisms, quantitative easing, you name it. There's all kinds of things they've done, but quantitative easing is the kind of catch-all phrase. And they essentially printed money at will through a keyboard stroke and used that to basically intervene in bond markets and drive interest rates down, and of course drive short-term overnight rates down to 0 or near 0, which is what they can do. But the goal of this was to stimulate inflation and fight what they feared was a disinflationary or deflationary impulse, and intentionally let real rates, as they're called, the interest rate after inflation, so-called real rates, go soundly into negative territory. And I think we're starting to see the ramifications of that. Well, actually, we've seen it for many years. The stock market and all kinds of assets have been bid up to, in a chase for yield, frankly, to levels that are beyond any valuation metrics in the history of modern times. We are in the stock market, even with the modest pullback from recent highs, we are grossly overvalued relative to 1929, for example, grossly overvalued relative to the 2000 bubble peak. And the consequences of that are almost certainly baked into the cake in the form of very disappointing returns from these levels in the stock market. Okay, probably negative if passively held over the next 10 years. And there's very good sound statistical models that would suggest that, if history is any guide. So is the Fed behind, losing control of interest rates? You might say they already have. And the inflation that has reared its head is a consequence in no small part by what's been done to interest rates. And it's clear that we think the central banks have gotten themselves in a bind here, in that we have grossly levitated markets that are priced on a mountain of low interest rates, artificially low interest rates, and the problem of inflation and all of that kind of stuff that can only be neutered with a rise of interest rates. So the policy error was made a long time ago. Now it's probably, we think, a very nasty menu of negative consequences. Either let inflation get crazy, or deflate or cause a deflation of the stock market. And of course, they're going to try and have it both ways. But we think that that runway is very short-lived at this point.
You're muted again, Matt.
Thanks, John. Yeah. well said. And it's sort of, death by fire or death by ice at this point. Real quick, just to finish out bonds here, Larry asks, how does an individual buy bonds? We had somebody here just put up a bunch of bond ETFs. Lance, I know that you've said you guys generally you're using TLT right now, but if there are any bits of other advice you guys would have to offer the person who's looking to add some bonds to their portfolio right now. And again, I think you guys mentioned this, but we should specify the bonds that you guys are adding to your portfolios right now are long dated US Treasury bonds, right? You're not loading up on, say, corporate debt right now.
Well, that's not well, yes and no. I mean, just for instance, we're also buying very short-term corporate debt with interest rates where they are right now. As an example, we just picked up a bond this morning that's got a 12-month duration with almost 2%, super high quality company. And, that's much better than having cash sitting in money markets for the next 12 months while we're waiting for other opportunities. So, rates have come up, which means that bond prices have come down, which means that a lot of the, good quality companies out there all of a sudden are yielding much better yields on bonds. So you've got to really kind of pick and choose. But where do you buy bonds? If you have an investment account with any major brokerage, Fidelity, Schwab, et cetera, they all have a bond desk. All you have to do is call up Schwab and say, I need to talk to the bond desk. And they can give you a listing of offerings of corporate bonds and treasury bonds, anything else that you want to buy. So, it's very easy to buy bonds, and you can probably and of course you can buy bond ETFs with just a click of a mouse. So it's really fairly easy.
If I could just say one thing, you can also go to Treasury Direct. You can buy them directly from the Treasury. Yeah. And, one other thing of note, we did just buy in the portfolio, in addition to the long dated Treasury ETF, TLT, just like Lance, we also bought a 2-year Treasury note. 24-month duration was yielding around 2.5, 2.53, I think we got, which is pretty incredible. I mean, so a lot of these expected, or in fact, probably all of these expected rate increases are baked in the cake. I was just talking to a client this morning that wanted to park some money for a while. For the first time in a long time, it makes sense to really just consider the 2-year Treasury note at 2.5 points.
Yeah. And remember, the 2-year Treasury note runs in front of the Fed rate. So what the 2-year Treasury note is telling you right now is the Fed's going to hike to 2.25 to 2.5. They're going to try to get there. The question is whether or not they cause an economic event or a crisis before they get to that level. But that's what the 2-year Treasury note's telling you right now. And again, if you go overlay the 2-year Treasury note with the Fed funds rate going back to 1960, they're almost a perfect correlation with each other.
Great. And two quick things. One is we've mentioned on this channel a couple of times that if there's enough interest that we will do a quick video on how to use Treasury Direct, which is the service that Mike just mentioned, where you can buy Treasury bills, notes, and bonds directly from the U.S. Treasury. I had put together a primer on that a few years ago, back when short-term T-bills were yielding over 2%, which was way more than you could get in cash in your bank. We may be heading back into that world again. There's a question here from Annette Hunt that says, I find it interesting 1 or 2 people have so much influence on the market. Case in point, Brainerd. What are your thoughts on her statement today about running off the balance sheet faster? I got to be honest, guys. I've been trying to, learn this new system here, so I've been a bit heads down today and did not hear what Brainerd said. If any of you did, can you just sort of put this in context for our viewers?
Well, basically, what she's saying is, well, he kind of said it. There's been a couple of people in the Fed. Bullard is another one that's a bit more hawkish, and saying that they need to reduce the balance sheet faster, they need to hike rates faster, they need to do monetary tightening faster in order to combat this inflation. They're going to make a mistake. The reason is that the inflation that we have right now is a function of $5 trillion worth of liquidity injected into the economy at the same time you shut down the economy and had no production. So that's what's caused this inflation. And what they're looking at this is saying, okay, this is a natural organic structure of inflation. We get a lot of people comparing us back to 1970s and going, oh, this is the inflation of the 1970s. It's not. In 1970, we had economic growth running at over 8%, savings rates were over 8%, average household debt to GDP, or their net worth exactly at that point, was about 60%. Mostly the debt they had was simply their mortgage, maybe a car. My dad, as an example, never had debt on anything, never had a credit card, pay for everything in cash. That was just that mentality that existed back then. So the inflation that occurred during that time is a bit different than it is today, because we had an economy that was pumping out, was mostly manufacturing driven, running at about a 5-time multiplier rate relative to what we have today, which is close to zero, because we're predominantly a service-based economy now. So when the Fed starts hiking rates here, they're going to collide with this fact that you've got this already natural extraction of liquidity from the market. All of that demand from that $5 trillion worth of liquidity is now going to reverse as supply is coming back online. If you take a look at inventories, manufacturers, wholesales, retailer inventories are all starting to rise, and inventory and the lack of demand is going to create deflationary pressures in the economy. As Milton Friedman once said, inflation is always and everywhere a monetary phenomenon, and it's only caused by that person that's printing the money, and that's the federal government. So this is going to be very problematic inflation-wise for the Fed over the next couple of months. And again, trying to push into this is going to be even more problematic for the Fed. And if they try to taper their balance sheet faster, extract even more liquidity at a time that liquidity is already coming out of the economy, you're going to have either a really bad recession, a very sharp sell-off in the markets, or some type of credit-related crisis. And generally what causes the big sell-off in the market is a credit-related crisis of some bank going under, a hedge fund needing to get bailed out, whatever it is. And that's very likely going to be the case in the next few months.
Adam, I'll just add one quick anecdote.
You know,
I didn't see the statement, but the statement is one that speaks to how excessive the liquidity is in the market. There's a concept called the liquidity preference curve. And I don't mean to get too wonky here, but it basically shows a relationship between base money reserves in the system and interest rates. And there's a very tight historical correlation between that. And based upon that, it could be concluded that there's several $1 trillion too much of base money for the relative the interest rates that we see right now. In other words, there's too much liquidity that the Fed put into the system relative to where they wanted interest rates to be. And I think they realize that. So the only way for them to suck that liquidity out is to do the reverse of what QE was. QE was printing money, going out in the market and buying bonds and filling the market with base money, zero interest rate, pieces of paper, basically. Now to reverse that, they got to do the opposite. They got to sell bonds, sell longer dated bonds that they bought, and take that base money out of the system. So that's why you're seeing today things like TLT we just talked about getting hit pretty good on those comments.
Great. And sorry, John, but is it less selling bonds to the market, and is it more sort of forcing bonds onto the market?
Well, yeah, I was kind to say selling. It's can we use the word puke or something graphic like that? That might be an appropriate word.
Well, but I say that just so folks really understand, everybody loves QE because you've got this infinite, checkbook that's walking into the market saying, yes, I'll buy your debt. Yes, I'll buy your debt. But QT is the reverse of that, where they're saying, I'm giving your debt back to you.
Right. But wait, but hold on a second. You've also got to be careful, because you've got to talk about duration. Over the last several years, the Federal Reserve has been buying a lot of much shorter duration bonds. So there's two ways to tighten the balance sheet. So when we talk about quantitative easing and ending quantitative easing, and this is what we did back in February, March, we said, okay, we're not going to do any more QE. That doesn't mean that they're selling any bonds. All they're doing is, as bonds mature on their balance sheet, they're buying new bonds. They're buying new bonds to replace the bonds. So the balance sheet remains flat. All quantitative tightening is, in theory, is yes, there could be the point to where they're going to the market and saying, hey, I've got to take $1 trillion worth of bonds and I'm going to throw them into the marketplace, and y'all all fight over them, whatever price you want to get. But the other option is to just not replace the bonds that are maturing. And there's a lot of very short duration bonds that bought over the last couple of years that will mature and just roll off. And the balance sheet will start to taper only by not replacing. So the liquidity extraction will still be there because they won't be supplying reserves to banks. But at the same time, that balance sheet will be coming off. And that doesn't mean they're necessarily dumping bonds into the marketplace, which they're going to be very reticent to do because they're aware of the consequence of doing that.
Okay. Yeah, no, that's a great clarification. That said, I again just want to sort of make sure folks get the spirit of QT versus QE, because QE is fun for everybody, right? QT is, oh, you're not going to buy my bonds anymore. Even if they just let the balance sheet roll off, it's still not fun, right? You had this dependable buyer that would take whatever you wanted to give it, and they're not taking it anymore. And then you have the potential that at some point they might come back to you with some of your debt and say, hey, like it or not, here it is, right? But you're making an important distinction there, Lance.
Right, and there's also one other big problem that's going to happen here is, the last couple of years, everybody's liked all these free checks, right? Send me a check to my household, give me more money, whatever it is. That's all a function of debt. And the way that the Treasury was able to do that is the Treasury would issue this excess debt, and the Fed's buying it all. And so the Treasury issues the debt, the Fed buys the bonds, the Federal Reserve credits the banks, for the bonds, and then the Federal Reserve then pays the interest back to the government. So there's this recycling of interest. But the only way for the government to do $5 trillion worth of liquidity is for the Fed to be the major buyer of bonds. The market can't absorb it. So, if you're expecting to have in the next downturn, the Fed, the government to come out and issue a bunch more checks and do a bunch more liquidity to support the market, they can't unless the Fed goes right back into quantitative easing and starts buying the bonds again.
All right, great point. Well, look, we're getting a lot more questions about quantitative tightening. Matt just asked, what day is quantitative tightening supposed to start? I think we can say that happened last month, right? I mean, rising interest rates, but rising interest rates is beginning to tighten though, right? That's beginning to extract.
No, we ended quantitative easing in March. Quantitative tightening will be announced in May.
Okay. So great distinction here then. So for the folks erroneously like me who was thinking, okay, well, rising interest rates is a way to start taking liquidity out of the market because you're making debt more expensive. That's not officially quantitative tightening. Quantitative tightening is really when the balance sheet starts coming down.
Right. Right now, they're replacing bonds. So as bonds mature, they're replacing the ones that are maturing.
Right.
So the balance sheet's flat. Right. Yeah. Now in May, they'll announce. Now in May, they'll announce quantitative tightening, but that may not start until September. We won't know until they make that announcement. Okay. It may start in May. It may start in September. May start never.
Okay.
We'll see when we get there.
Yeah. And for those who actually watch the Fed's balance sheet, has it actually officially stopped growing?
No, it's still going up. Last time I checked, I haven't checked today.
Okay. Yeah. And we won't totally dive into this, but I mean, that's a huge part of what the Fed does, right? It jawbones, right? It talks about what it's going to do to try to influence market behavior. It will always talk more than act if it can get away with talking more than acting, right? So to your point there, Lance, we'll see what happens when and maybe even if QT happens, because to what you were saying, if something breaks beforehand, those plans can pivot, can come right off the table, right? And somebody up here made a question about how high mortgage rates we're getting, and perhaps maybe we can just talk about that for a second, because most people here watching, I'm sure, are homeowners. But most of the guests that I've had on this program, especially guests like Daniel DiMartino Booth, who's very close to the Fed, have said the Fed will tighten until something breaks, and that's when they think the QT process will end. Guys, at a 5% mortgage rate, is that a level of concern that that housing might start to shiver there? And I think, Lance, when we talked last, you said that where we are currently with general market rates right now was an area that you already beginning to get nervous about. But maybe anybody that wants to jump in, but where do you guys think the threshold is with rates where the wheels start to get really wobbly here? Because our economy is so over leveraged compared to previous cycles. It just can't handle as high interest rates as we had in the past without really getting into trouble.
I'll offer a quick answer. I don't really think there's any way to prove mathematically what levels are critical, but we just saw rates go from 275 to above 4 at the same time that we saw one of the largest year-on-year increases in the average price of a home last year, and jumped nearly 20% in 2021. 2021 was a year of extremes in so many things. A rush into real estate, meme stocks, NFTs, crypto, and the stock market itself, all on what we think are blow off tops. And so there is certainly going to be a breaking point. I don't know what it is. I mean, I think we're starting to see already days on market start to creep up a little bit. But I can just tell you from talks with our clients and prospects that it's been an absolute euphoric bubble market and nothing but bidding wars, and almost the sky's the limit. And so it's not going to take much of interest rates to really break that bubble. I don't know where it is, but we've gone, like I said, above 4%, and we could easily go higher. Looking at the long-term charts, it looks like we could go to 6 or 7% on the 30-year mortgage. I mean, certainly that's going to affect affordability. Already, people have been stretching beyond their means, because as interest rates go down, hypothetically to zero, you can almost afford an infinite price for something. So again, I don't really have a scientific answer here, but in this area, I'd already start to be concerned with all of the euphoria and the bubble-like tendencies we've seen in that market, particularly over the last 6 months.
Yeah, one thing to also remember is that housing is a function of what happens on the margin, right? I own a house. I'm not buying it or selling it right now. So I have, interest rates and mortgage rates have nothing to do with me at all. So what happens though on the fringes, right, on the edges of the real estate market is what drives that activity. Now, for a lot of major banks and a lot of major mortgage companies, et cetera, that refi business is gone. It's over. Nobody's going to refinance from a 2% mortgage to a 4% mortgage, right? It's just, that's not going to happen. Home equity extractions are going to just basically go away because that rate is going up. And remember, over the last few years in particular, a large chunk of the home buying contingent has come from institutions buying up houses to turn them into rentals. And, so a lot of the people that when we talk about home buying attitudes, et cetera, that's getting to the point to where most of those people are getting priced out of homes. And I think I agree, that we may not be just there yet. Maybe it's not 4, maybe it's 4.5% on 30 year, maybe it's 5% on 30 year, but somewhere in here, I think all of a sudden you're going to start to see, a lot of this housing activity come to a standstill very quickly. And that's going to really kind of expose the underbelly for a lot of these major banks and mortgage companies. Again, we're talking about credit risk, right? We've got all kinds of leveraged loan debt in the market, collateralized loan, covenant light loans. All those are contingent upon interest rates. And then don't forget, we've got a big chunk of small and mid-cap companies that are dependent on debt issuance just to stay alive. And, we talked about these zombie companies before, and as rates go up, they're potentially going to get priced out of the refinancing activity of their debt. So there's a point in here that rates become a problem in a market and an economy that is as highly leveraged as it is.
All right, great. We've got Cal in the green room. Cal, stay there. We're going to get to you, buddy. But there's a few threads on this I want to pull on. God, you guys just introduced some great topics here. One, I want to dig a little bit more into housing, but two, I think we all, when we talk about the Fed hiking until it breaks something, I think we all sort of look at credit really as the big threat there, which is kind of what Lance was just talking about. You start having these cascading issues with debt. I want to get your thoughts on what those look like. So let's start with housing, and then we'll go to the greater credit market. So guys, on housing, Lance, you already said the refis have dried up. Now, obviously that's impactful from an economic standpoint because that money drives consumer spending, right? And consumer spending is, the big engine of the economy. And for a lot of people, their house is their biggest asset, right? And mathematically, as mortgage rates go up, housing prices, in theory, need to come down, right? So if rates go higher from here, and again, the average rate is already approaching 5 here, if it goes to 6, if it goes to maybe 7, and maybe we get this recession that the inverted yield curve is forecasting here, we could kind of begin to have this perfect storm going on, right? Where we have, the already incredibly huge affordability issues going on. Buyers just completely go on strike. You have people who start losing their jobs or getting their income constrained. How bad could this get, guys? Is this something that you're increasingly getting worried about? Or, it's interesting because I've issued some recent tweets about this, and it's amazing the belief systems at play. There are half the people are saying, yes, housing's way overvalued, can't wait for it to go down. It needs to for society's sake. And then other people saying there's no way it's ever going down. Inventory is too tight, and corporations are buying all houses, and they can outcompete all buyers from here. So anyways, how worried are you guys about what may happen with housing from here?
Let me just jump in real quick, and then I'll let Mike and John run with this. But let me just say one thing about inventory. There is no such thing as a housing inventory shortage. The reason is simply this, is that there is a price. If somebody knocks on my door today and says, Lance, I'll give you $2 million for your house, sold. And it won't take but just 2 seconds for me to tell my wife to pack bags and we're moving. In fact, you get the house with all the furniture in it, right? So, there is a price and there is a point that drags inventory into markets. And what will happen is that as prices are going up, right? My house price has been going up where I live too, just like everywhere else, right? It hasn't reached the point of stupidity to where I'm going to sell my house and have to go buy a new house somewhere else or build a new house, right? Whatever. But there's a point that I will, and it will pull inventory in the markets. But there's this contingent of people that are not currently up for sale, but they're thinking about it, right? I'm close to retirement, thinking about downsizing. Maybe I'm going to move. Maybe I've been thinking about moving, but maybe next year, year after, whatever it is. But when prices start to fall, all of a sudden, as you said, it's their biggest asset. When the price begins to fall, all of a sudden there is a rush of people to market to try to cap. They see that price going down, like, oh, I don't want to miss this because I'm getting ready to move. They rush to market with inventory. And this is why if you go back and look at history, every time you get into a pre-recessionary cycle in housing, you'll start to see supply and inventory rising rapidly. This isn't people building more houses. This is people rushing to market to try to sell the house at the current prices. And that's what you're already starting to see. Housing inventories have been coming up. We're up to about 6 months of supply now. And when you get to 8 months, you're in a recession.
Yeah, right, great. And Mike and John, I'll let you guys answer just real quick. I sent an email to Ivy Zellman yesterday, who's the housing expert that I've interviewed on this channel a couple of times in the past, because she has mentioned that in the quote unquote smile states, which is where the really hot markets are, the Houstons, the Austins, the Phoenixes, the Dallases, the Miamis, there's been a lot of ferocious construction that's been underway for years to bring more supply online. And we're getting to the point where that construction is getting ready to hit the market. And a fair amount of it's been delayed over the past 2 years because of the pandemic and all the supply chain issues. Those issues are now getting resolved. So you potentially have this, I don't want to say tidal wave, but you have this dramatic increase in new supply poised to come into these markets, which potentially could coincide with that sort of rush to the exit that Lance was just talking about, making it even worse, right? It's like almost the worst time for this new supply to potentially hit the markets. All right, sorry, John, you go ahead.
Yeah, no, not at all. And I totally agree with Lance. There are some interesting sub-dynamics in housing and in terms of dislocation, maybe even still after the COVID. Generally, people have been, wanting to move out of cities to more rural areas. Whether that trend is played fully out, I don't know. But the concept of what Lance spoke of there in terms of there's no shortage of sellers. In fact, there will be a barrage of sellers if and when prices start to plummet. I would say that is spot on. And I would say it's not limited to the housing market. I think the stock market is every bit as ripe, probably more so, because it's so easy to sell your stocks. Selling a house is not so easy. When you get bubble valuations in the stock market like we have right now, that dynamic can play out in magnified ways. So, and that's what causes bubbles and the carnage in bubbles, whether it's housing or stocks or this or that. But spot on, I agree with that, Lance.
Wait, John. Yeah, John. Let me add something to that because John hit the nail on the head here. Is if we go back to every previous kind of crash market in history, right? So we go back to the 1970s, it was the Nifty 50. In 1987, it was portfolio insurance. In 2000, it was really this kind of, dot-com stocks, right? I mean, there was a lot of companies actually did very well during the dot-com crash. Small cap, mid caps did fairly well during the whole dot-com debacle. In 2008, it was real estate for the most part. it's something that both Mike and John brought up earlier is that we now have a bubble in everything, right? And I'm really reticent about using the word bubble, but you have a overvaluation in everything right now, whether it's real estate, whether it's equities, whether it's cryptocurrencies, whether it's just a variety of assets really across the board. No matter where you look, there's excess price built into the markets, which suggests that we could potentially have this next problem that we have, whatever it is. It won't be relegated to just real estate. It won't be relegated to just stocks. It won't be relegated to just whatever other investment class it is. Private equity, SPACs. As a good example, I was doing an event recently, co-hosting an event for a mergers and acquisitions kind of foray, right? And there's all these M&A guys that were there, and they were just talking about, this is November, talking about all the money just laying it. You could just go anywhere and just pick up money out of the street gutter and finance a business. It was just that easy. People just throwing money at anything that was going on. That's that type of attitude that typically reverses very quickly and very harshly in markets. And my concern is that it happens across multiple asset classes all at once.
Right, that raises the question, obviously, well, where do you go to ride out that storm when that happens?
Cash and bonds.
Help remind me to get back to that. I want to bring in Cal, though. Cal is our first brave soul to come in and actually ask his question live inside the experience here. So Cal from California, I'm adding you in here now. Thanks so much, buddy. I like your all wood background. I'm a little partial to that myself. Good job, buddy.
Thanks. It's actually a print. But first of all, thank you for having me on the show. I'm a huge fan. I love all the insights and information that you guys can share to us. We're so lucky to get that for free. I actually have a question for Lance. I know that recently you have mentioned how when the yield curves invert, that's usually a sign that recession is near. I thought that was surprising and insightful. And I wanted to know if you have any other correlations that you use to trade or invest. For example, if you would have rotated from tech, from value back into tech when it went to 2 standard deviations overbought compared to tech recently, I think you would have done quite well. And so I'm just using that as an example. Do you have anything like that that you use to trade? Thank you.
No, that's actually a good question. Yeah. So, so first of all, let's start with yield curve inversions, right? So the important thing about yield curve inversions are it's not one yield curve. It's not the 10-2. It's not the 3-10. It's not the 2-5. It's all of them. When you get multiple yield curve inversions, that's what tells you that you have an economy or a situation that's ripe for a recession. So as I was explaining this to Adam last week, I think, is that we're talking about, think about a pile of tinder laying on the ground. You pour gasoline on it. It's fine, right? I mean, you just got stinky tinder laying on the ground. It takes a match to ignite that flame. And so what the yield curves tell you is that you've got everything, you got all the ingredients necessary for a recession. You need a catalyst to trigger it. That's going to be some event, whether it's rate hikes, whether it's some credit related event, whatever it is. Generally, it's not rate hikes. The rate hikes cause some event that then triggers the recession. So again, that's what I was talking about earlier, is the thing you want to watch for rates uninvert. That'll tell you that you need to be much more defensive very quickly when that begins to occur. Now, in terms of, trading and investing, those type of things, you hit the nail on the head. Back in November, we were talking about being long value stocks heading into November, December, January. That worked out very well for us. About 3-4 weeks ago, we rotated out of some of those value stocks into tech stocks as the Russian invasion, Ukraine was working, because tech stocks had gotten very, very beat up, very oversold. And again, we do a lot of standard deviation work. So looking at standard deviations from the 50, the 200-day moving average, those type of things, gave us an indication that those had gotten really beat up and there was a tradable opportunity. We bought those, sold those when we got 2 standard deviations overbought. So part of our portfolio does work on taking advantage of opportunity when it's there. But again, the big chunk of our portfolio is longer term analysis. So again, when we're buying stuff, we're generally adding 2 positions that we previously reduced and bringing them back up to market weight or overweight, and then bringing them back down to target weights or underweight. we are long-term investors. We are long-term goal managers. That's what we do. But also those same type of analysis in terms of technicals and fundamentals all play a big part into how much cash we hold versus how much fixed income versus how much equity. And right now, that's why we're carrying a good bit of extra cash, because of the problems that we've had. This big run up in the market looks a lot, smells a lot, tastes a lot like a bear market short covering rally from a couple of weeks ago. And with the Fed hiking rates and now beginning to taper the balance sheet, our concern is that valuations and earnings are going to matter, because earnings are going to start to deteriorate here along with economic growth. So holding a bit more cash is going to be opportune for the time being. Here's an important point about inflation. Inflation affects your cost of living. So if you have cash sitting in a bank that you're living on, that's getting eaten up by inflation. Actual cash in your investment account that you're used to buy stocks with, that's increasing purchasing power as we get into a market decline, because I want to hold cash so I can buy assets cheaper that will outpace inflation as they return to fair value over time.
All right, Cal, did that answer your question, buddy?
Yeah, that was great. Excellent. Thank you very much. I appreciate it.
Thanks,
all right.
Cal.
Look, Cal, thanks so much for being our first volunteer here. Really appreciate it. And folks, if you want to ask your question live like Cal just did, send your email to info@wealthion.com and we'll tell you how to get into the experience here. But anyways, Cal, thank you so much, buddy.
Thanks, guys.
All right, folks, really quickly, if you're enjoying this new format or have any feedback on it, please just let us know in the chat here in the comments. We'd love to know if you'd like to see us do more of this in the future. And while you're at it, do me a favor, hit the like button, click the subscribe button as well if you're not yet subscribed to this channel. Okay, guys, got a number of questions here to go through in the time we have left. And guys, I hope you don't mind. We're probably going to bleed over a little bit in the hour, talking to the three experts here. I hope that's okay with you guys. We just have so many questions. But let's get back to the one that I mentioned earlier before we brought Cal in. So you guys talked about the, I don't want to over-exaggerate it, but the hyper vulnerability, the extreme vulnerability of this sort of everything bubble that we're in. If indeed we get that kind of cascade that you guys were just mentioning there, where do you guys expect at this point in time, understanding that you're at the end of the day, you're going to make your decision based upon, the data that you're seeing at that moment. But where do you think right now, where do you expect you're going to be placing your capital to ride out a storm like that?
Yeah, I'll take that, Adam. It really depends upon what the washout looks like, and but we would expect that we would be interested in what we perceive now to be the undervalued sectors: oil and gas, commodities producers, and emerging markets. Also would hope that those would fall less in a general decline, but really can't answer that question definitively until we see what it looks like. These markets are extremely overvalued, and nobody knows when they'll fall or how far they will fall. But the stock market is close to $50 trillion in value relative to the size of the U.S. economy, or GDP of $20 trillion. Long-term valuation metric, one that's been used for many years, is called the Buffett indicator, or the stock market capitalization divided by GDP. And anytime above 100%, Warren Buffett himself has said in the past that the market is in bubble territory or shaky ground. Putting that a different way, assuming that GDP stays relatively stable, and it probably will have trouble going higher from here for a lot of different reasons, there's at least $30 trillion of air between the current stock market capitalization and the economy. So there's a lot of risk to the downside, and a lot of other valuation figures agree with that concept. So we will look for the washout, see what it looks like, and then we'll start to be interested in sectors that outperform, that start to emerge early from the washout. And we can't really tell what those will be at this point.
Okay. Guys, anyone else want to chime on that before we move on?
I absolutely actually agree with Mike. And again, my first go-to is when there's going to be a recession and I'm, all the indicators are kicking in, we're starting to break key levels of support. My first go-to is going to be cash and bonds. Cash is look, you don't have to be a genius about investing money. Cash is a risk-free hedge. I go to money market and I can't lose money. You know, the problem with trying to short the market is I take on a risk. If I'm wrong and markets go up, I lose money in my short. So there's a risk to any investment that you make. Cash is a zero risk hedge. So sometimes the best thing to do, if you don't know what to do, just go to cash. Then, to Mike's point, you can start to see and let the market, look, you don't have to be smarter than the markets. You don't have to try to predict what the markets are going to do. Let the markets tell you what they're going to do. You'll be able to see things that are bottoming and turning up, buy those things that are outperforming, sell the things that are underperforming. You don't have to do everything all at once. You don't have to make big movements in portfolios. That generally leads to making mistakes. But again, cash and bonds are going to most likely be the best place to be starting. And then if there's a lot of fear in the market, precious metals will do well. If there's not so much fear in the market and we start to see a rotation to real value, then Mike's absolutely right. Stocks that have real value on their books, and Procter & Gamble is not a value stock, but there's a lot of stocks that are really value-oriented stocks. Those are going to perform and at least hold up a whole lot better than growth-oriented stocks. So yeah, but just you don't have to make big moves.
Okay, great. And I just want to underscore something I've done in past weeks talking with you guys, but one of the reasons why Wealthion endorses you guys, one of the many reasons why Wealthion endorses you guys, is you are not afraid to be in cash and at times hold a substantial percentage of your portfolio in cash if that's what you think is in the best interests for the risk management for your clients. And I just want to underscore that because there are so many people that come to us with sort of these horror stories about how they've been treated at other financial advisors who always, in every situation, have them 100% allocated. And there's just sort of this insecurity on behalf of the financial advisor with that, well, I can't have you in cash because you could be in cash yourself and then you wouldn't need me. And it places these people at undue risk. And I know at some point in time, it can be a little bit hard sometimes to tell your clients, yeah, we've got you in, material amount of cash right now, given what we think about the markets. And it's that courage to do the right thing, I think, is both commendable, but it's also pretty rare in this industry. Okay. Anyways, moving on.
Adam, if I could just add one thing on that. So in that context, what we, and Lance probably agrees in the way he thinks of cash, the real value in cash there is the option value, if I could use that term, to convert that cash to some other asset at some other point in time than right now, that then becomes a more compelling. So in an overvalued market, we're saying, broadly speaking, stocks are not attractive now, but they will be. And that cash allows one to avail themselves of that option. And I just want to touch upon, there were some questions in the chat here about covered call ETFs and things like that. I don't want to speak specifically about any ETFs, but we do a lot of work with options, covered calls, and sometimes protective puts and callers. What we would imagine our playbook to be in a material retreat in the market is to use some of those tools because, for example, covered call writing is a very proper way to invest in stocks, but have a hedge, or at least a partial hedge. And it just so happens that the income generating potential of selling call options is higher when volatility measures spike, which typically happens in a market sell-off. So we look at options as a great tool to kind of, be a little bit imprecise on timing and still be okay. Those hedges essentially give you some payment, some error factor in terms of precise timing, and they're very much a part of our quiver.
All right, I'm glad you mentioned that. I think risk management is a good topic to talk about. There are two other important ones I want to get to before we wrap up here today. Folks, I just tweeted out a URL to a guide that Wealthion has published in the past that sort of gives a good overview of all the common options to the regular investor in terms of how to hedge your portfolio. If you haven't read that, you've got the URL, go read it now. You can get it for free. It's a really good, I think, just sort of introduction if this topic of risk management and hedging is relatively new to you. Before we move on to these other two topics, though, guys, anything else about risk management, your firm's approach to it, or its relevance in a portfolio at this time, given market conditions like today? Anything you want to say before we move on?
No, I agree with what John and Mike were saying a second ago. Cash is an option, right? And he's absolutely right. what cash gives you. And look, we've talked about this before, is that in any investment you make, you can only have 2 of 3 outcomes. So if I'm investing in stocks, I can have return and I can have liquidity because I can sell stocks. If I buy bonds, I can have a return and safety, but I give up liquidity. So cash gives me liquidity. It doesn't give me a lot of return, but I've got the ability to convert that cash into an investment. Excuse me. At a moment's excuse me. Choke myself up at a moment's notice.
Right. This is making you real emotional there.
Sorry about that.
No worries. Get yourself a glass of water. All right. Well, look, I underscore risk management because one, we at Wealthion think it's a critical part of portfolio management. It's certainly relevant given all the macro risks that we have today, and we've talked about a lot of them here already. But your 2 firms, RIA and New Harbor, are some of the absolute best practitioners of risk management that we've found in the long time that we've been at this. So anyways, anything else you guys want to say about that, feel free to integrate in any other answers that you give here. But I want to move on now to, I'm going to pull up a question here from Scott, which I'm going to just morph a little bit, where he says inflation is going to roar here, right? And nobody knows exactly what's going to happen from here. But what's different about this moment in history, right, is that the Fed has to contain inflation, right? That's what's pushing it into quantitative tightening. But rates are still near historic lows, right? So it has a lot less wiggle room or ammunition to use that it's had in previous cycles where it's tried to attack inflation. And then, we were talking about the Fed's going to tighten until something breaks. So the big question here is when that happens, when things begin to get really rocky, which do you think the Fed is more likely to do? Pivot to try to save the economy and the markets and let inflation run hot, which isn't a good outcome, or could Powell step into the shoes of Volcker here and say, hey, look, I'm going to tame the inflation monster no matter what the cost in the short term?
This is the big debate, right? So,
yeah. Well, I'm going to ask you to speculate. What does your gut tell you?
Well, my gut tells me that given the political dynamic, okay, again, we have to talk about everything in a vacuum. We have to assume that everything remains status quo with everything else, which means we've currently got a political environment that is leaning much more towards socialism, modern monetary theory, consistent bailouts, those type of things. And so if that is indeed the case, and if that mentality remains status quo, that means the Fed has much less wiggle room in terms of trying to combat inflation before they are forced, either politically, societally, et cetera, into bailing out households, bailing out markets. And more importantly, let's not forget the most important thing. Despite the fact that we have these annual stress tests of the major banks, every time we have a downturn, we have to bail out the banks. And don't forget, the banks are members of the Federal Reserve. So my best guess and my assumption is that, again, everything remaining status quo, as soon as the banks start squealing over mortgages going bad or whatever it is, there's going to be the Fed stepping in to bail out banks, buy junk bonds, pull out the whole quiver and the wagon that they brought out last time, because that's now the new standard for monetary policy. But one thing on inflation real quick, it's important to understand how we calculate inflation. It's like inflation's going to roar. We're just going to have, we're going to 15% inflation, whatever it is. Okay, that can happen. I'm not saying it can't. But if we have $5 a gallon gas today and $5 a gallon gas next year, inflation is zero, because we calculate inflation on year-over-year appreciation. It doesn't mean that that prices go down for you, but there will be no inflation if prices don't rise from here. So again, you have to look at the inputs into inflation and say those inputs, car prices, house prices, oil prices, those are all just going to keep going up. And that's all a function of supply and demand. So if liquidity is coming out, inventories are coming up, what happens to the supply-demand equation?
All right. John, Mike, anything to add to that?
I think I'd just say that Powell or this current Fed is no Paul Volcker. I don't think have the courage. I don't even think they're even close to that. The question says the Fed can't raise rates much because the precious bubbles will pop. It's obvious they have to do something. And you've had many guests on in recent weeks and months, Adam, that have said, look, the Fed is going to raise until the bubble pops. It's probably true, but they've shown nothing but wanting to take the easy way out, and got no doubt that they will turn and reduce rates again to try to save the markets. Now, the real question is, will the scheme work, or will the market continue to fall anyway, despite all of their efforts? And I, for one, hope that eventually their efforts fail and we can return to some kind of free market, even though at this point it's going to be pretty painful to get there. I think that's likely what's going to happen. We probably see a pivot. And at some point, though, I think this market, maybe even after a knee-jerk reaction or bounce, starts to fall anyway, because the market eventually figures out that the gig is up and there's no plan B. That's my best guess.
And that's the problem. And John, you're right. I'm sorry, Mike, you're right about QE, which is that every time we do QE, and goes back to we started QE in 2009-10. Every time we have to do QE, we have to do more of it. Every single round of QE is larger than the last because of what we call the efficacy of the monetary interventions. In other words, the markets are accustomed to a certain level. So in order to get, it's kind of like a drug fix, right? You take drugs, and after a while, you just don't get the same high anymore. So you've got to take more drugs to get the better high. It's the same way with the financial markets. And this next round of QE will have to be substantially larger than the last to get the same effect. And here's the interesting thing, just to put this into an easy analogy to understand. Since 2009, and this number is still rising, by the way, we've done over $43 trillion worth of government bailouts, QE, et cetera, from bailing out Maiden Lane and Bear Stearns to doing TAMP and HARP and all these different, government bailout programs, to the QE programs, buying junk bonds, you name it. $43 trillion. The economy is only 20 trillion. So we've already done, and that's in total. And if we look at just the growth of the economy since 2009, we spent $12 of government money for every dollar's worth of economic growth. So every time to get that same dollar's worth of economic growth, we've got to keep doing more and more bailouts to get that same dollar's worth of growth. So to Mike's point, there is an end game to this, to where the markets may say, and I don't know whether it's this next time or the time after or 10 times from here, but there'll be a point somewhere that markets don't buy off on the QE and say this isn't working anymore.
Yeah, and you're making sort of Lacey's Hunt argument for him there, which is there actually is a point at which an additional dollar of government spending actually no longer yields any growth. The additional debt overlay actually starts contracting. Yeah. So, all right, last topic here, which this is a good segue from. So we're either looking at continued inflation, right? If the Fed decides to pivot here, maybe even if it goes back to QE, right? And that's just going to make the inflation story even worse, which should be very gold positive, right? Or we're potentially looking at what you guys were just talking about, which is where the market basically loses faith and has a big sell-off, and then gold's role as a crisis protection hedge, that should be gold positive too. New Harbor, I know you guys have precious metals as a decent chunk of your portfolio. Let's conclude here just talking about your guys' outlook for the precious metals right now. I think we've talked separately in a bunch of different videos with both of you guys in the past about a lot of the fundamentals and technicals that have looked like they've been really improving a lot and getting to, in some cases, some historically bullish states this year. That said, gold is hit a record high a couple of weeks back, but it's kind of range bound right now. What do you guys think about gold? I'll start with the New Harbor guys, since you guys hold a fair amount of it, or at least in the form of miners.
Okay, I guess I'll respond to that. We've been watching gold for a long time. It's been in a triangle consolidation. It hit a swing high in August of 20, somewhere around $2,100 an ounce, and then pulled back for the next year and a half. And we most recently saw another swing high, and this was timed roughly in conjunction with the Russian invasion of the Ukraine. However, we don't really think it's a geopolitical event per se that is causing the bullish move in gold. We really think it's a long-term trend, a consolidation that's been happening for a long time. Again, this triangle in gold has been really building since August of 20, and we've just recently broken out of that in the last couple months. In the 6 months before that, gold had tried to break to the downside 3 separate times and touched, I think, 1680 or so, when it was rejected each time. We believe that gold is taking off to the upside. Even though it's pulled back a little bit to about 1920 or 1930 as we speak, a little more than $100 off that swing high a few weeks ago, the bullish pattern still is intact. And looking at gold stocks, if we take GDX, which is an ETF that we could use as a proxy when we talk about gold stocks, it's right around 40. And it's actually starting to act relatively better than gold. In recent days, when we saw gold down, GDX and the whole gold mining complex has been up. So gold miners are hanging in here at a high level consolidation, even as gold is pulling back. And it looks to us like gold wants to make a run for maybe 2,500 by year end. And that would put GDX up into the 50s, probably, maybe even 60 from its current 40. You know, bear in mind that none of these, of course, are guarantees or projections. That's just what the charts look like to us, and it looks very bullish.
All right. There's a good question here from Marcus. I just sort of listed a bunch of reasons why, gold looks good. Mike, you just sort of reiterated a lot of that. Is there any reason against gold? Are we all in on this trade, or do we think that there are, potential reasons that could either invalidate our thesis, or they're just times that are bad to own gold?
Well, no, I think you have to quantify your time frame for owning gold, right? So, Mike's right. If you take a longer term look at gold, there's actually a formation that's occurring called a cup and handle, which is very bullish for gold, and we're long gold in our portfolios as well. And there is a good technical setup, but again, it's about time frame. If your time frame is, hey, I'm trading gold, or I think gold's going to work for me over the next 3 months, 6 months, whatever it is, you could well be disappointed. The reason is that gold is a fear trade more so than it's an inflation trade. If you go back in history and look at gold versus inflation, there's long periods of time where gold vastly underperformed inflation. So it's not a great inflation hedge, and kind of looking at it that way, but it's a great fear trade. Whenever there's a fear of a market collapse or war, those type of things, gold performs a lot better. We haven't had any real fear in the markets in the last couple of years, which is why gold hasn't really performed all that well. But if we get back into a state where we're in a recession and the markets are coming down, gold should perform fairly well, because again, is that psychological risk off fear trade. That's what really drives the underlying price of gold. But again, you've got to give that time to play out, because that's a 6 month to 12 to 18 months trade, but it should do well.
All right, great. And I think I just add on, because we get this question a lot, if there is sort of a sudden sharp market sell-off, like a big market correction that happens in a compressed time frame, it's highly likely that gold and silver will get sold off initially in that, just because sort of everything gets dragged down when people are getting margin calls, right? What do? You sell what's retained its value. Okay, well, I got to just start selling this gold and silver because the rest of my portfolio has gone to hell and I got to meet my margin call. But the theory is that selling should abate pretty quickly, and that gold and silver would then recover much more quickly than the other assets in the market. And we've seen precedent for that in 2008. But just wanted to make sure that folks were well aware of that. All right. Well, look, I'm going to have to start wrapping it up here, folks. Our experts, thanks so much for staying a bit late for us. From the comments I've seen so far, it seems like this new format is a winner, and folks would like to do it again. There was a good suggestion in there that in addition to sort of doing these Ask Anything sessions, that maybe we do some of these that are focused on a particular topic, like bonds or how to hedge against inflation or precious metals or whatnot. And if that sounds good to you, just let me know one way or the other in the comment section below. All right. And I want to close, folks, with an invitation for folks to like this video again and subscribe, but with a huge thanks for everybody. And I'm going to see if I can get one more bell or whistle here to run. Right before we hopped on here, Wealthion received its 100,000th subscriber. So we were able to hit that essentially by this channel's 1-year anniversary. This channel started in early April of last year, and here we are just a year later with over 100,000 subscribers, and that is completely due to the support of all of you watching this video. So thank you so much for helping us get to this important milestone, and hopefully it's just the first of the momentum that we're building here with this whole movement for Wealthion to help people become more financially resilient. Lance, Mike, John, I want to thank you guys so much. Everybody else, thanks so much for watching.
Thank you, Adam.
Thanks, Adam. And thanks for all the great questions, folks. Really, really worked our brains. Thank you.
See you next time.
All right, guys. Thanks for everything.